Hello, I'm Kim Stafford, and I'm here again with PIMCO Group CIO Dan Ivascyn to give you an inside look at some of the recent discussions taking place within PIMCO's Investment Committee, or IC. Thank you for joining us, Dan.
Thanks, Kim.
Tariffs and policy dynamics have been impacting everything from inflation to growth to asset valuations. How are we thinking about analyzing and integrating these into our baseline and risk scenarios? And how do we translate these into portfolio implications for our clients?
Yeah, so I think the first step is to just acknowledge that there's a lot of uncertainty. Still a lot of uncertainty in terms of the economic situation, a lot of uncertainty around inflation, which still after several years now remains above central bank targets. And policy is highly unpredictable, both in terms of the content of policy itself, as well as the delivery of policy. So, we're spending a lot more time today balancing more traditional economic and financial market analysis with scenario analysis, questions, and different assumptions around the trajectory of policy, tariffs being one of them, other forms of policy, tax, stimulus, Fed policy, all are other important areas of focus for us, including policy outside the United States. With that said, I also think it's important, at least within the fixed income opportunity set, to remember that yields or income drives a significant portion of the overall return. And after a few years of relatively weak performance, we're now at a level today where starting yields on a global basis in terms of the overall global opportunity set are quite attractive. So yes, there'll be noise. Things will zig and zag along the way, which can create a lot of opportunity to add alpha relative to passive alternatives. But at the end of the day, over a multi-year time horizon, you should earn an attractive return. And across the high quality end of the opportunity set, you can generate potential yields today in the 5, 6, 6.5, even 7% range. And even looking at a trailing 12-month basis, those are the type of returns that have been realized.
So yields are very attractive. Fixed income has had positive performance and momentum this year. Looking forward, markets are pricing in the fact that the Federal Reserve will probably cut rates in September. How do we think markets could respond? And importantly, how should investors prepare and be positioning their portfolios?
Yeah, so we do think the Fed cuts rates in September. We do have a little bit more economic data before that decision. Our base case thinking is the Fed is increasingly focused on weakness on the employment side, is willing to look through what we expect to be slight to moderate increases in inflation over the short term as tariffs do begin to roll through into consumer prices. But, we do think that you could see another cut or two after the September cut, acknowledging some of the weakening that we see in economic growth. And of course, what's going on in terms of the Fed, the administration's approach to the Fed, the upcoming appointments at the Fed, the new chair of the Fed, very well could change the decision-making framework in a material sense versus what most market participants are familiar with. So lots of uncertainty. Base case is that there are going to be a few rate cuts from here, bringing that cash rate lower, further steepening yield curves, and particularly yield curves in the front end of the market. It's been several years now where you don't pay much of a cost or you don't give up too much yield to own cash. We're getting to a point now where you're going to finally have the potential for steeper yield curves in the extreme front end. And that has implications on fixed income performance, what type of yield you can generate depending on whether you're sitting in a money market or a cash type investment versus extending out the curve and locking in some of those higher for longer rate type outcomes.
So with that backdrop, what is your advice to investors on how they can best prepare for this upcoming environment?
Well, a few things. One is have a sufficiently long-term horizon. There's a lot of localized volatility, but sticking with an income-oriented investment, even an investment with a little bit more interest rate risk, will likely pay dividends over the next few years. Again, looking back at the trailing 12-month returns, that has certainly been the case. I think the second point just relates to correlations. As inflation has gotten down to a more reasonable range relative to central bank targets, there's a likelihood that a strong or significant fixed income allocation will benefit an overall portfolio. And then, we talked about attractive valuations in an absolute sense. I think it's important to note as well that fixed income looks attractive not only in an absolute sense, but also relative to equities at these levels. Then the last point relates to thinking about a global opportunity set. It's still appropriate to focus on some of the higher quality areas of the market, given how tight credit spreads are. And by expanding your opportunity set across the globe, you can minimize the amount of economic sensitivity across the portfolio, generate comparable or even more attractive returns to some of those credit-heavy alternatives that people had to rely on for many, many years when high-quality interest rates were low or even outright negative in some parts of the world.
As more investors consider private credit, what perspectives can we offer about balancing both the potential return opportunities with the related risks? How do we think about allocating between public and private credit? And how do liquidity, transparency, and credit risk influence this mix?
These are highly related markets. I think rather than just talking about public and private, I think it's important to look at investments on two different continuums, one liquidity and one economic sensitivity. There are areas of the market, the private market, where there's very little to no transaction liquidity. No ability to exit that position. And although there have been discussions about liquidity convergence in markets, a good portion of the private space requires the borrower to give you permission to sell an instrument. Those investments should warrant a more significant pickup in spread relative to their liquid alternatives. And then in other areas of the private opportunity set, there is pretty significant transactional liquidity. There's no practical reason why you cannot source risk, create risk, work with issuers looking to access these markets in a manner that doesn't preserve material liquidity. And in those areas, again, the requirement for liquidity compensation can be less. So I think investors have to take a look and make apples to apples comparisons. And I think there's some interesting value that can be uncovered by being very, very careful to make those precise comparisons. And the bottom line is, equity valuations are stretched. There's a lot of money moving into the private assets. A lot of the players in that space seem to at times be competing based on market share as opposed to the underlying value proposition. So not surprisingly, the average pickup for going down the liquidity spectrum fairly narrow, but very, very different depending on what areas of the market or what particular investments you're targeting. And the whole point of what we're trying to do on behalf of investors is look to ensure that we get an appropriate level of compensation for the relative liquidity. And a lot of that takes very, very careful underwriting of increasingly complex transactions. On the economic sensitivity piece, and again, we're most cautious about the more economically sensitive areas of the market. No different than our public portfolios, where we have been reducing credit exposure to more economically sensitive areas, things like senior secured bank loans, things like the high yield market, although the high yield market's a much higher quality market than it's been in the past. Same view within the private opportunity set. At the other end of the extreme, the higher quality areas of the market, asset-backed, asset-based lending, areas where we're quite overweight in both our public strategies, our hybrid strategies, and our private strategies, we think continue to make a lot of sense.
Great. Well, thanks very much, Dan. And thanks to all of you for joining us. We'll see you next time.